My name is Ray.
Hi, this is Michael.
Welcome to another video of Ray's Economics Clue Book. Today, we will talk about the Federal Reserve System and its extension of its monetary policies.
Okay.
So last time I went over what the Fed's structure is all about. So the Fed at the top is the U.S. Central Bank. It has three key entities. It has a 12 Federal Reserve regional banks around the nation, with each with its own governor. It has Federal Reserve Board of Governors, and it has a FOMC, arguably the most important branch, the Federal Open Market Committee, that determines its open market operations that could directly impact the money supply. This committee is made up of this committee is a combination of our reserve banks, regional reserve banks, and our Federal Open Board of Governors, because all 7 Board of Governors are on the FOMC, and 5 of the 12 reserve banks are always shifted onto the FOMC. However, New York is always one of those 5.
Yeah, because the FOMC, most operations
go through New York.
Goes through the New York Fed,
So the Fed has 5 key functions based on its 3 key entities. First, it controls the nation's monetary policy, which is quite evident. Also, obviously, it helps maintain stability of financial systems. It supervises and regulates financial institutions. It fosters payment and settlements and safety and efficiency within financial systems. And it promotes consumer protection and community development within the economy. And so the Fed, from this, derives 2 most fundamental mandates. It maximizes employment and it maximizes price stability. It handles and through the monetary policy, most famously, it can impact our economy in those 2 factions.
I would say that some national, most of the central banks, they focus on the price stability only. Okay, so the U.S. Fed is a little bit different. They actually have dual mandate, right? Maximize employment and maintain the inflation target. Okay.
So the Fed has a balance sheet just like any other bank. Its assets are mainly government debt. Government debt in the form of treasury bonds that it purchases or sells in open market operations. So let's say it has an open market purchase of $1 billion worth in treasury bonds. Then this increases its assets by $1 billion. If it has an open market sale of $1 billion worth of treasury bonds, then its asset decreases by $1 billion. However, conversely, its liability is monetary base, which is currency circulation plus our bank reserves. Mainly, in this case, bank reserves that are deposited within the Federal Reserve. So because just think about it as a consumer yourself. You individually, when you deposit into a bank, those deposits are still your assets and the bank's liability, because the bank pays interest on your assets, your loan or your deposit. So its monetary base includes its deposits or reserves and its currency circulation. So an open market purchase of $1 billion would increase the monetary base, currency, and reserves by $1 billion. And so it increases liability by $1 billion while also increasing its assets by $1 billion. Its open market sale of $1 billion worth of treasury bonds would decrease its liability by $1 billion, because the monetary base, currency circulation plus reserves total decrease by $1 billion.
Shrinks by $1 billion. Actually, we already highlighted the chain reaction. Open market buys and federal credit banks, right?
And so open market operations, they increase or decrease a bank's excess reserves, but most importantly, it affects its bank's excess reserves, and the bank can loan out or make financial transactions with its excess reserves, which has a chain effect, as we discussed earlier in our earlier videos, throughout the economy to increase the money supply through spending.
So they adjust the money supply by just the open market. So it looks very simple, but it really has significant impact.
It's main tool that it can use to directly impact the monetary supply rather than just impacting the money multiplier. So let's look at the Fed's assets in real life. The Fed's assets, of course, a lot of it's U.S. Treasury bonds, as we expect. However,
before 2008.
Since the 2008 recession, we see a lot of it also come in the form of it owning mortgage bonds and agency debt, mortgage-backed securities. Why is this the case? Well, 2008, the recession was famously caused by the real estate housing bubble, and the bubble burst because many mortgage-backed securities, basic securities of many mortgages,
go bust.
Many mortgages in bulk packed in one security, they went bust because of subprime loans. And so, as they went bust, remember, one of the Fed's main goals is to stabilize financial markets, or in this case, real estate market, financially speaking. And so, it stabilized the MBS, it stabilized the mortgage-backed securities MBS market through taking it over, basically, and buying many of these failing MBS mortgage-backed securities. And so, we see it share of MBS and its assets climbed dramatically since 2008.
Actually, in 2008, the market is so dire, okay, in such a a distressed status, and Federal Reserve becomes the last buyer.
Yes, the last resort.
Yeah, the last resort. That's why you see, before 2008, they don't really hold too much, to MBS, right? So, but after 2008, that's a significant increase.
Yes.
And so yeah, and they also buy a lot of U.S. Treasury bonds through the open market operation. Of course, we already explained why this is very beneficial to the economy, because it's pretty much the same as injecting a lot of cash.
As we saw earlier, changes in its assets also coincides with a change in its liabilities.
Yeah.
So we look at the Fed's liability changes. We see most of it is probably in 2008 at the same time, the amount of it that's in the reserve deposits exploded basically.
Yeah.
Because mainly as it goes out and increases the money supply through financial transaction, as it purchases mortgage-backed securities, and as it makes open market operations, it's injecting money into the
financial system.
Yeah. As the money supply increases, bank reserves increases, and reserve deposits increase as well.
Yeah.
And so since 2008, we see so much quantitative easing that the reserve deposits proportion of the Fed's liabilities rocketed up from very negligible amounts to almost half of it.
Yeah, that's because most of the cash injection was to the financial institutions.
Yes.
For example, because most of the MBS, most of the treasury bond actually held by large banks, large financial institutions with banking operations.
Such as, and as you mentioned, that limit this increase in Federal Reserve in reserve deposits and its liabilities coincided at the same time as Lehman Brothers filed for bankruptcy. Because this is a prime example of large institutions going bust under this failing financial system.
Yeah.
And so for our final clues, the Feds have three main tools for monetary policy. Earlier in the videos, we talked about the federal funds rate and the discount rate, and the reserve requirement as a way to influence the money multiplier effect on spending.
Sure.
And however, open market purchases and sales, quantitative easing, and quantitative tightening are the main tools it uses to directly influence or inject money into the economy, basically.
Yep.
And so through the bank's excess reserves and reserve deposits, this is how the Fed can inject money into the economy. And because as it makes open market operations, banks' reserves are affected and banks' excess reserves are also affected, which influences how much they can spend within an economy and create a chain effect.
Yeah.
And so just like how our deposits in the banks are our own assets and the bank's liabilities, a bank's deposit into the Fed is the Fed's liability. The Fed is the bank for banks, basically.
Yeah.
The Fed is the bank's bank. And so it's the reserve deposits are the Fed's liability, and the reserve deposits are the bank's original own assets.
You think about that, just the banks are Fed's customer.
Yes. Yeah. Just like how your bank is your bank, the Fed is the bank's bank, your bank's bank.
Yeah. So actually, right now we are in a quantitative tightening, right? QT. So $50 billion, the sale of for each month, right?
Yes.
So that's pretty much like say they actually withdraw, right, liquidity, withdraw cash from the whole financial system. So it's kind of like a stress test for the banks. Let's see. So what's going to happen, right? Okay. So basically, I hope those. Clues actually delivers basic points clearly to all of you guys. So I look forward to see you guys next time. Bye bye.